Hello and welcome to our podcast, The Active Investor with SGH. My name is Alastair McKibbin, the Head of Research and Consultant Relations at SG Hiscock & Company, and I will be your host for today's episode. But before we start, please read the disclaimer in the episode description and note that this episode is recorded on the 20th of March 2025. With me in the studio is Travis Prentice, the Chief Investment Officer and Fund Manager at the Informed Momentum Company. Hello Travis and welcome to Australia.
Thanks for having me. It's been fun so far.
Excellent. Well, Travis co-founded his company IMC, which was formerly known as EAM Investors, in 2007. They manage over $4.1 billion Australian in assets for their clients across several momentum-based strategies, from large caps all the way through to micro caps. As well as being the CIO of the firm, Travis is also the fund manager and analyst for all global and US strategies. IMC is based in California and San Diego specifically in the United States. We live in pretty interesting times at the moment, Travis, especially in your country. And there's no shortage of discussion topics, and I think the presentation that we've been talking about has been Trump, tariffs and trade turmoil, which is a lot of T's. But where are you as a fund manager seeing opportunities at the moment, given that backdrop?
Yeah, well, a lot of T's. Americans like alliterations, and every time I come to Australia, being an American, they always ask about Trump for sure. That's the first thing everyone wants to talk about. It's a popular topic. No, we would obviously advocate for trying to tune out the noise as much as possible and focus on the signals. And certainly from a market perspective, if you can do that well, I know it's hard, but if you can do it well, you can find opportunities kind of no matter what's happening or whatever Trump might be saying at the moment.
And you have a specific focus on momentum, which is a really interesting way to approach markets. Can you explain what that specifically is?
Yeah, well, momentum is the simple theory, and I think there's empirical evidence to suggest that it's a very strong factor premium in global equity markets, but the basics of it is that when stocks outperform, they continue to outperform for a certain period of time, thus momentum. So think about it as stock-by-stock trends, and trends last for a period of time, and if you know how to identify them early and exploit that trend, there's a very strong factor premium associated with momentum.
Okay, so you talk about factor premiums. What other factor premiums do you compare momentum to?
Yeah, I think we compare, I think the major factors, we compare momentum to all of the major factors, but when you look at what most investors would consider to be kind of the big four factors would be value, so owning companies that are cheap, quality, owning companies that are more profitable, growth, so owning companies that have grown or predicted to grow, but most often from an academic perspective, that's also expensive stocks.
Sounds like you have an axe to grind with growth.
No, yes, maybe a little bit, but yeah, and then momentum would be kind of the big four that we see in most investors' portfolios.
And those are the four factors that really Fama and French have sort of really their academic work has been based off measuring those and explain market returns.
And I would say that they did describe momentum as the premier market anomaly.
They did, the premier market anomaly. What does that mean? What does mean when someone says momentum is the premier market anomaly?
So, technically speaking, it's what at least the three-factor Fama French model can explain. So it doesn't span momentum, but in practical terms, I think it's probably the biggest affront to the efficient markets hypothesis. So it's the anomaly that empirically has been the strongest. So it is probably the biggest argument against a pure form of efficient markets.
So when you say it's the strongest, do you mean that that's the strongest in terms of absolute returns or maybe risk-adjusted returns?
Yeah, that's a great question. Yeah, you should probably qualify that in terms of what we mean by strong. So simply speaking, I guess if we look at the research we've done or the research that others have done, if we just look at it from an excess return perspective, so excess return versus a broad market, momentum has the highest excess return. So that's probably the most simple definition of strength. But even if we look at it on a risk-adjusted basis, which is probably more important from an investor perspective, perhaps, momentum outperforms in about 75% of the markets we tested across geographies and market caps.
Okay, 75%.
So it is a premier market anomaly, kind of however you measure it, and even a T-stat, so the confidence level of momentum's historical outperformance is quite high.
Excellent. The strength of the signal is high. So that's interesting though. So you talk about it being the premier market anomaly, but I can buy cheap stocks pretty easily. I can buy stocks that are highly profitable. and I can buy stocks whose earnings are perceived to grow. How do you identify a stock that's either been performing well, that's long enough that it will continue, and not have a false positive? How do you identify those names for a portfolio?
Yeah, and that's really the philosophy and process that we've developed over almost 3 decades now that we call Informed Momentum is basically built to harness the power of momentum and actually produce results in real life. Because there is quite a leap you have to make from the academic theory, which, look, momentum's actually quite simple in theory, but it just turns out to be really difficult to harvest consistently in practice.
Yeah, because growing up in this business for 20 years, it was always that momentum is almost a byproduct of something else. It's how many fundamental managers speak about momentum, especially if they look at it from any kind of portfolio analysis software. They think, oh, I've got a high momentum coefficient. Oh, that's because I'm good at picking growth stocks that are appreciating because their earnings are growing. What would you say to that?
Yeah, well, I would say the highest expression of momentum investing would be that, actually the foundation of the philosophy itself would be that the price signifies something, signifies some information. So we actually, and what we believe in is that momentum works empirically. Buying companies that have worked over the most recent past will continue to outperform for a period of time. But we think the highest expression of momentum investing is the intersection between stock prices that are outperforming and businesses that are doing well.
Okay, so you're not just looking at the price data, you're looking at fundamental business, you're looking for a change there that justifies the price appreciation.
Yeah, absolutely. We want both things occurring at the same time.
Okay.
So when you break down momentum investing to its kind of easiest to understand form, and which we think why investors should consider momentum, is basically just you want to own some percent of your portfolio in companies doing well. And that's a simple.
That is a very simple and very easy to understand philosophy.
Yes, exactly. And so it's the confluence of stock prices that are outperforming, which is the ultimate arbiter of truth, right? Is stock price performance. That's what creates alpha. But we think what sustains that momentum, if you will, that for it to persist long enough to capture alpha, it has to be buttressed by something happening in the business. So a business improving will continue that momentum trend for an investable horizon.
So I guess people who have owned the Mag 7 or FANG stocks or any name
whatever
that's given to this bunch of mega cap tech.
I think it's like Mag 3 at this point.
Mag 3 it's
we've lost a couple of them.
We have, I think, in recent times. But ultimately, I think momentum outside of that small cohort, maybe, and even with them, doesn't last forever, or does it? How do you, is there a time limit horizon on how well a stock has to do? How do you think about that, the time invested in a name or a portfolio or a strategy?
Yeah. So the momentum premium is robust. It's persistent through time and it's pervasive across asset classes. However, the signal decay from momentum is actually quite rapid. So if you look at kind of the alpha signal decay or the holding period that you need to have on average to extract the momentum premium, so companies that have done well, so say for example over the last 12 months, there's a high probability that they will continue for a period of time, but that period of time lasts about 9 to 10 months.
Okay.
And after that, it'll actually turn against you and it'll be a negative performing a stock or portfolio. So what's really important for momentum is to keep that portfolio fresh, to continually moving that portfolio to strength and away from weakness. So the reality is for a momentum strategy to actually work, you need some turnover to keep that average holding period somewhere within that period of time. Otherwise, you're not going to extract the premium.
That makes sense. I can understand that. And so the benefit is you identify a stock, or you identify momentum early, you harness that premium over the time, and then you sell out before that alpha has decayed, and you refresh it into something else that will then repeat the same.
Yeah. So the biggest risk with momentum investing is overstaying your welcome. Right, so
I've never done that.
Yeah, we've all probably done that in some aspect. But yeah, so the only two variables that matter with momentum investing from a stock by stock risk perspective is the amplitude of outperformance. So how much is that company has outperformed by, and then how long has that outperformance been going on? So the more amplitude of that outperformance, the longer it's gone on for, the lower the probability of it continuing in the future.
That makes sense. I understand that.
Yep, things cycle. Yes, everything in life cycles, including stocks.
But markets chop and they change, and no strategy is foolproof, as I understand it.
There is no return without
I think there was a hedge fund manager in New York back in 2008 who had foolproof returns. But
that didn't end
outside of the $67 billion of investors, no. But how do you then, your momentum strategy will face challenges in certain market conditions. What conditions does it face challenges in, firstly? And secondly, what do you then expect from a performance perspective in that challenge and then coming out of that challenge?
Yeah, sure. So yeah, like any source of alpha is not without risk. That wouldn't be a premium.
For sure.
Right? So when momentum struggles is when you get abrupt leadership changes.
Okay.
That it tends to occur around market volatility in general, but whatever upsets trends. So that could be a macroeconomic shock. It could be DeepSeek in January 27th of this year. Something that changes perception and changes leadership is when you would expect momentum to not do so well, at least in the short term, right? Because at its essence, it's trend following, right? Where you're identifying trends, you're writing those trends, and then something has to upset that trend. So if it's a short, sharp, sudden change of leadership, that's generally when a momentum strategy will suffer. However, after those periods of time, the momentum refreshes or corrections tend to be short, sharp, and sudden.
Okay.
So they tend to be very sharp, but also don't last very long. So we wait for those time periods and then invest, and generally the returns coming out of those dislocations are pretty strong.
So anytime,
at least if history is any guide.
Yeah, and I think that's ultimately what any kind of academic study or your quantitative analysis is seeking to do, is to understand history, understand the strategy,
Absolutely.
and harness the benefit of the premium, as academics would say.
Yeah, so I would say to kind of bring that full circle, the price of the momentum premium is persistence, right? So when you get hit, you just got to carry on. You got to keep moving. Whereas value, the kind of the cost, the price of that premium is patience, right? Value tends to
underperforms for a long period of time, and then it experiences rapid, say like 2022, 23 is that a good example of?
Yeah, correct. So value tends to hurt you with small cuts over time that accumulate, and then you get a huge period that tends to be actually maybe 18 months or 2 years of massive outperformance. So you got to have the patience to get paid with that value premium. You gotta withstand that to get the payment. So momentum's exactly the opposite, which is why it's a great pair.
So I guess if I'm thinking about this from an investor standpoint, if the moment you go through a momentum drawdown or a period of underperformance, that's almost a great signal or sign that performance premium, that premium will start to return, and you can expect better days ahead.
Yeah, and if you pair, we would always preach diversification in anything. It's kind of the closest thing to a free lunch out there in finance land. And generally speaking, when momentum has its tough periods, not every time, but most of the time, value is having a good time. They tend to be negatively correlated. Like the last 14 days has been rough for momentum, and actually value is kind of held in much better. So the pairing of those two styles, I think, creates diversification nirvana.
Well, the interesting thing about momentum as well is that it's somewhat chameleon-like. It's, to your point, it's going where the trends are. It's going to the areas that have performed well and the expectation is will continue to perform well. So what does that look like today, and how do you find that fits with a broader portfolio?
Yeah, you're absolutely correct. I mean, I think the reason why the momentum premium has been so strong over the years is its adaptability, like you said, chameleon-like. It doesn't care. It's not biased towards any sector, industry, country. It's just going to go to what's performing and away from what's not. So what we're seeing right now is quite fascinating in terms of where we're finding Mo. And we were laughing earlier.
I was going to say, how long have you been coming to Australia for?
About 8 years. You think I'd know better by now.
I was going to say, my favourite slide of yours was, where is the Mo? And when I met you, Travis, I looked at you and thought, yes, indeed, where is the Mo?
It's not a mustache. It's not a mustache.
In Australia, Mo is moustache. But that's, you've got to learn something every day. And Travis, next time.
Yeah. Well, maybe we'll change that.
Looking forward to the facial hair.
But it's so much more fun to say, where's the Mo?
Instead of
where's the momentum?
Go with the Mo.
Go with the Mo. There's so many fun things you
can
do.
Go with the flows, yeah. So.
Go with the flow. You got to be in Mo.
That's all. Go with the Mo.
We just came up with some good tags.
So where is the Mo?
Yeah, where is the Mo?
Mo money, Mo problems? No?
Yeah, so in our global portfolios, we're seeing much more Mo in. Okay, I'm gonna stop laughing about that. But we're finding much more momentum in places we haven't seen in quite some time. So China, for example, Europe, Germany, even we see strong momentum in a couple Greek banks as well. So we're seeing momentum in a lot of places that we haven't seen in quite some time, and quite strong early momentum. And on the other side, we're seeing far less momentum in India and the United States at the moment.
So you mentioned earlier that you're seeing momentum you mentioned that you've got China, you've got Europe, and you've got even Greek banks that are showing momentum, but you mentioned there's fundamental reasons as part of your process to identify that momentum. Can you, from my perspective, I'm keen to hear, and I'm sure our listeners are keen to hear, what the fundamental reason for that momentum is in China or Europe, and especially in Greek banks.
Yeah, different flavors for sure. But in China, what we're seeing very strong momentum is in across the board, but primarily in the technology complex. I mean, I think with DeepSeek, there's been a kind of a renaissance within that sector in China. So we're seeing a lot of opportunities there. So either companies that are helping build out data centers in there, or companies that are harnessing the power of having a more efficient large language model, for example. So the innovators using the AI tools to create products and services. We're seeing a lot of opportunity there. Europe, we're seeing most of the strongest momentum in defense-oriented companies, or aerospace and defense.
Okay. Is that a Trumpian effect?
Maybe. I mean, he's going to take credit for it no matter what. But yes, yeah. I mean, obviously, we saw what happened with Germany in terms of their fiscal spending and changing some of the legislature there. And they've obviously committed to an increase pretty dramatically in defense spending. So there's a lot of beneficiaries of that trend. And obviously, when we're looking from the bottom up, we're going to find idiosyncratic drivers of that. But overall, that's kind of the theme that we're seeing. And then European banks, and we mentioned Greek banks, I mean, if you look at some of these companies, they're generally overcapitalized, actually.
Strong balance sheets, absolutely.
Strong balance sheets. So now they're obviously returning capital to shareholders, which tends to be a positive phenomenon. But also loan growth is picking up in certain areas. So yeah, you're seeing a lot of positive momentum in both business and price at the moment.
That's really exciting, especially for those areas that I think investors have probably not paid that much attention to, or have been not that excited about for quite a period of time.
Yeah, seems like almost my entire career. Yes.
I was going to say Europe. When was Europe last?
Yeah, well, I mean, 28 years is a long time, but yeah, I mean, then that's what's great about momentum, right? And what we do and why we love it so much is obviously we have a systematic approach, but we're monitoring all these signals, these momentum signals across countries, across sectors and industries. And when you look at the world objectively like that, free of any bias, it's just fascinating where you can find some of these alpha opportunities.
Well, I was fascinated by some of the stocks that you're not really you're a bottom-up stock picker ultimately that is looking to harness momentum in every single name. And two of those names, or one of them especially, I found to be that we were talking about earlier this week or throughout this week, is particularly entertaining. I thought a name that most people wouldn't, again, it's a great example of your process working for a great outcome that may not necessarily happen if you put just a purely fundamental lens across it. Do you know what I'm talking about, by the way?
Well, which one? There's many. Pop Mart, is that the one?
Yeah, exactly.
Yeah, we were laughing. Well, not laughing about. Well, I guess we were actually. Pop Mart. Yeah. Pop Mart is kind of like the Crocs story, right? Where it's like, well, I can't make a judgment whether these small toy figurines are something that's popular, but if I look at the evidence, it suggests that it's doing very well. And this is a Hong Kong-based company, Chinese company, but
it makes bobbleheads and
kind of pop toys. But they've actually been quite innovative.
Well, that's what I thought was actually the more interesting and amusing thing, was not just the bobbleheads, but the innovation of their product.
Yeah, going after toy bricks and kind of building upon that foundation of pop figurines and doing a lot of other innovative products, but also expanding geographically, outside of China into Southeast Asia and also in North America, in the U.S. I think they opened a store in New York that's done very well. So the global appeal of this has been profound for the company.
That's amazing. And I guess one of the other names you talked a lot about was Wingstop in the US. Is a name that had done incredibly well. I think a lot of small cap managers in the US domestically owned Wingstop, possibly globally as well. But do you want to go through the thesis of how you invested in Wingstop, what they did, and also the price trajectory of that stock over the last few years, and when it did well and when it maybe struggled, and what led you to buy and ultimately to sell?
well, this may be the only instance where we did deep fundamental work with all the wings and kind of consume as many different flavors as we can with all the sauces. Very, very deep research in that one. No, I'm joking, but not really, because we like the wings. Fantastic wings. Anyways, but so every company that comes into our portfolio has to manifest itself in kind of observable signals, momentum signals. So like price, obviously strong momentum, but also strong fundamental momentum indicator. So it had all of our signals that we capture systematically. But what was happening at this company when we purchased it was, again, innovation. We think innovation and reinvention really powers improving momentum and persistence of momentum. And what they had was a menu innovation. So launching a chicken sandwich at the time. Wings and
innovation. Yeah. Wings with bread. Yeah.
Which was very popular, and then embracing service like DoorDash and Uber, really expanding kind of their addressable market with those services. So really poised for very strong fundamental and price momentum. But these things cycle. So what generally happens and why we think the momentum premium works is largely behavioral, right? So at the beginning of these trends, there tends to be an underreaction to the information, to what's happening at the company. And then ultimately, the way momentum pays off is that at buy point, it's underreaction, and at sell point, it's an overreaction to current fundamentals. So it just tends to be that investors, once they see good performance, good growth, they tend to extrapolate it far too far out in the future, and what you get there is elevated expectations. So the discipline with momentum comes in not only finding those new trends, but not staying too long and riding it all the way back down. And so that was a case where expectations just had caught up and gone far too far.
So it's a really disciplined, it's essentially a really disciplined sell discipline is what you have.
Yes.
To word something very poorly. And that great, that provides the outcomes that you're looking for. Whereas I think I might be wrong, you may differ. A fundamental growth manager may look at the headline growth numbers and the earnings and what they're able to do and think, well, hang on, the fundamentals of this business are still really strong and their growth is fantastic and they're in the top echelon. We're going to hold this name because we see the fundamentals being persistently strong, whereas your differentiation would be, no, that's great, yes, that's true, but this price is way overcooked, and thus the alpha signal will decay, therefore we sell.
Correct, yeah. We think what drives, at least in the short to medium term, what drives alpha is expectations and changes in expectations. And so from a traditional growth perspective, if they have that view perhaps of a company, they may be right in the long term, but what you're going to have is some pretty big boom bust cycles with that. And so we're always thinking about what's next, what's at the margin, and analyzing trend. And if we see trend break either price wise or fundamentally, we're going to move on and not ride it through these big cycles that you get through quote unquote traditional growth type companies.
Yeah, that makes it. It's funny. I think we were discussing earlier. It's the in almost every other aspect of life, people talk about, I just need some momentum. Oh, this, momentum's changed, it's shifted, whether it's in sport or life or product or business or what have you. But you've never heard that. I've never heard that in 4 years of being in the asset management business. No one's ever, we need some momentum.
Yeah. It's fascinating.
Why do you think that is?
Well, you're absolutely right. In every aspect of life, everyone wants momentum. But in the finance world, it seems like momentum sometimes it's like a bad word or something. And it's fascinating. But I think, partly it was kind of what the conversation we had earlier. I think from an academic perspective, momentum is an affront to the efficient markets hypothesis. So there is kind of this, I really don't want momentum to work, but it does. Oh man, it does, but I don't want it to, but it does. So I think that's part of it. But I think there's some misconceptions about momentum. One probably chiefly would be, momentum just tends to get confused with growth, like that we just kind of talked about. And so some investors, think growth and momentum are synonymous, and I would argue, and the evidence suggests that they're quite different disciplines. So I think that's the first kind of foremost confusion. I think the second one, probably more important, is there just tends to be a perception that momentum's overly risky. And maybe if momentum's not done well, it can be.
Like anything in life.
Like anything, you got to do it well, and implementation is everything. But if you can compare it to like a premium where it's accepted as as gospel that it has to be in your portfolio value. If we compare it just on objective evidence of the momentum premium, the value premium, and you look at drawdown analysis, you look at all the kind of risk return characteristics, based on the evidence, you would say they're about as risky as each other. And in fact, in the US, actually, you can make an argument that momentum's less risky than value. So it's just a perception. I think it's the manner of when momentum underperforms is maybe part of that negative perception. So it just hits you and you can't miss it in that month or whatever that it might underperform, whereas value kind of kills you by 1,000 cuts and you don't really notice it. Or one of our clients explained the value premium is being kicked to death by a duck, which I found pretty funny. Meaning it's small over time, but it accumulates to a problem. But it's not 1 month where it really hits you. You know what I mean? So I like that. That's a good analogy.
Never forget that analogy.
And then the last one, I think, just real quickly, why you don't hear more momentum is just it's hard to do in practice. We kind of talked about that. And you can't manage as much money as some other strategies that don't need the turnover. So I think there's a lot of reasons why you don't hear about momentum as much as you probably should based upon its merits.
Even though it is obvious, it does have some really obvious material, tangible benefits for a portfolio as a whole. And you started your career, your entire career has been based in harnessing momentum for investors.
Correct, yeah. 28 years now, yep, almost 3 decades.
And you started at a larger asset management firm that was acquired, and then after that happened, you and your team split out and set up EAM Investors in 2007. 2007 was a very interesting time, I imagine, to be launching A, an asset management business, and B, an asset management business who was focused on delivering returns through investing in momentum. Can you walk me through briefly that experience and what you learned from that and how that's informed what you've done subsequently?
Yeah, I was going to say, it might take some time. There's a couch over here that I'm staring at. I might need to lay down and go through that psychoanalysis. But yeah, so we started, and worse than that, we started in October of 2007.
Oh, like one month before the peak.
Literally at the peak. So that's an experience that I don't want to go through again. But I think the silver lining of that is that it really forged our culture in fire, right? So I think the 3 things that I think differentiate us are the focus, like doing momentum as long as we've learned a couple things along the way, and momentum's all we do. So the focus on that I think is important. And then the skill we've gained through those years of intense observation is another differentiator. But the last one, I think, to your point more, is grit. Because momentum's a premium where you have to bring your lunchbox to work, coffee, and grind it out every day. It's like full contact in the trenches, kind of premium to harvest. So grit, it has to be within us and our team. And obviously, starting when we did, if we didn't have grit, we wouldn't be here.
Yeah, you would have had to have a lot of I imagine the conversations with prospects, let alone existing clients, would have been very challenging, especially in those early years.
I guess the only good news about that is we only started with $3 million of largely our partners' capital. So only $3 million in assets under management. Maybe it went to about 1.5 in the GFC. We built our business even with that terrible start. So market timing is not part of our strategy. You probably can guess, but
that was the persistence part.
Yeah. So we built that though, client by client, brick by brick, and I think that's it's been an advantage for us to go through that. But we don't want to do it again. Yeah,
you said market timing is not your thing, but you've been telling me this week that now's actually a really good time for momentum investing, given what's recently happened. So just to not to make too light of it, but
it's like Cliff Asmus. If you're gonna market time, it's a sin, but maybe there's better times to sin a bit more than others. I don't know.
Well, I think what was interesting, certainly one of the most interesting things that you mentioned was obviously that the stairs up from a premier standpoint, the elevator down, but then the stairs kept going. And then that, from your research, one of the strongest signals that you have and your rationale, your logic for this I found really insightful, was you talked about 52-week highs being almost the strongest signal for future outperformance than anything else you could look at. As something that intuitively I never would have thought this. Could you explain to our listeners why that is, how that came about, and what you think that means?
Yeah, so 52-week highs has been part of our panel of momentum signals that we capture. And it seems counterintuitive, but when we in our studies, the highest information coefficient of any one of our signals alone by itself is proximity to 52-week high. So the closer to a 52-week high, the better. It's the most predictive. It's the highest prediction of any one of those momentum signals alone. But all the signals we use together are more powerful than any one of them. But if you're going to pick one, 52-week high is the best, which is. But I guess if you think about it from
my perspective, but
from a behavioral perspective, I think it makes a lot of sense. And we're not the only ones that done research on it. You can find some of it. But if you think about, no one generally wants to pay the highest price for something, right? It's just not what you want. It's not what you go out at a cocktail party and go, I paid the highest price ever for a stock.
Well, you've got to get used to Australian property prices, people. Conversation might be slightly different in that context.
Exactly. Which is a good point, actually. That's why momentum works well in real estate, but that's a whole nother podcast. But so behaviorally, though, if no one wants to be that person that bought the 52-week high, everything else being equal, that company is probably undervalued. And I think that's why it works for behavioral.
It's a really interesting observation and logic behind that I think would be, at least from my perspective, incredibly not thought through.
Yeah, and I think in the disclaimer that we're not giving investment advice in general, specifically. So if you buy a 52-week high and it doesn't work, don't come after
the first slide.
On average, over time, in normal market conditions, it'll work well.
That's why they hire you to do it, to when to. It is interesting because so many people, so many clients of ours over the last 5 or so years have really, especially in global equity portfolios, less so in Australian equities, but definitely in global equities, have really struggled to how do they keep up with the benchmark, because the benchmark has, well, those big names had that momentum, and people would ask, Pine and clients would think, well, hang on, how do I can't just go overweight and max 7, but at the same time, how do I beat or keep up with that benchmark? And the answer, I guess, from all our interactions this week and our meetings, really seemed quite simple in a way, which is you add momentum to the portfolio.
yeah, that would be a good.
That would be the natural conclusion from mine. Because if you have a discrete allocation to a momentum-based strategy, then that solves a lot of those problems. Is that a fair assessment, or am I just trying to sell people on something?
Well, I'm biased, but I think you're right. But I think you're absolutely right.
If you're being objective.
Look, I mean, and when it's not, I think it's important that, a lot of managers will obviously be biased to what they do every day. But I think in this case with momentum, there's a strong amount and a copious amount of evidence already that suggests it works. So it's not just someone saying it. You can go out on Fama and French's website and do the calculations yourself, and you'll find the same conclusion we have, which is it's a very strong premium, and it's a fantastic exposure to have over the long term. So it's not just us saying it. So I would say at least we have evidence and facts to back it up of what we say, which is what's great about being more of a systematic-oriented investor.
For sure. No, I think it's a really interesting strategy. And the way you approach investing is something that, with tangible benefits that investors find hard to access almost anywhere else, I think is amazingly powerful as we go and speak to clients and prospects, and the feedback we've obviously received this week.
Yeah, and it can offset risks. I think the other part is utility of momentum, right? It's not just a source of excess return. It actually provides pretty strong diversification benefits within a portfolio that's allocated to quality or value. Momentum's going to improve outcomes if you have it in a certain percentage within a diversified portfolio.
And one of the interesting things as well.
We just got serious at the moment. That was a very serious.
That was a very interesting turn. The facial expression for those of you who it's changed.
Yes, diversify your risk.
I'm sure I've not heard that one before.
Yeah.
But what was interesting as well, I think, many things have been interesting this podcast, but the up capture and down capture ratio of your strategy, to me, again, intuitively, if someone says, what's the up capture of momentum, of a momentum strategy, I would naturally think it'd be 120 on the upside and maybe 80 on the downside, and your extremes on the up and extremes on the down. But that's 120 on the up and 120 on the down. Sorry, you're up. So extreme on both ends.
It's been a long week.
It's been a very long week. But you'd be extreme up and down. You'd be extreme on both ends. But that's not the case.
Yeah, it can be the case if
in the short term.
Yeah, if momentum's not done well, it could definitely be the case for sure. But with our strategies, which look, every day for us is risk management, stock by stock risk management, but holistic risk management, which is part and parcel to informed momentum, not just momentum. And so what we've been able to show over a long track record in our strategies that go back, some of them 17 years now, show definitely a beneficial upside downside capture that surprises most people. So we do really well in the up markets, 100% plus. But in the down markets, depending on the strategy, we're somewhere between 85 and 95% downside capture. So it's not just a good time strategy, it actually can add value kind of cross cycles.
And that speaks to, I guess, it being a premier that through informed momentum you're harnessing versus riding a trend that just to its, the magnitude of having a high beta strategy, for example.
Yeah.
The difference between harnessing a momentum premier versus investing in high beta stocks.
Yeah. So I'm gonna insert my only economics joke I can think of, which is we always believe if you're gonna forecast, you got to forecast often. So yes, you got to move when the signals, when the evidence changes. Yes.
I think there's a lot of benefits. So from what we've discussed this week and on this podcast, I think there's a lot of benefits to a strategy like the informed momentum strategy. You harness a risk premium that is hard to access. You deliver returns through the cycle. You outperform in up markets and down markets broadly, and you provide diversification to many people's existing investment styles. And so I think, and this is again all of the feedback we've received this week as we speak to people, is it has a really interesting place in people's portfolios. And in the global small cap universe, which is where we have our fund, the IMC Global Small Company Fund, why do you think it works particularly, or the informed momentum process works particularly well in global small caps?
Yeah, it's a good question. I think, first and foremost, I think it works well because just the selection universe is so broad, right?
How many names are in the bench?
Yeah, the index is over 5,000.
That's a lot.
But in the selection universe, if you just look by market cap, it's more like upwards of 10,000. So a huge selection universe to choose from across industries, sectors, countries. So if you just take a small subset of that, right? We have 150 or so holdings in our global small strategy. You're actually always focused on the best of the best, the strongest trends within that. And if you're unbiased to where it comes from, you can find hidden gems. So like I said earlier, I'm borrowing from Jim Cramer, although I don't know if you know Jim Cramer.
Jim Cramer, CNBC.
Yeah.
Short Cramer.
Yeah, there's always yeah. But he does have a great line. There's a bull market somewhere. There's always a bull market somewhere. We used to say that, I think maybe even before him, but he's the one that popularized it. But yes, but in essence, what he's talking about is momentum. There's always something working somewhere. And I think it's just the case within global small cap. Across this myriad of opportunities, you can find gems if you know what to look for. So I think that's why probably it works better in small if you have the concentration of the winners, the momentum stocks, versus a huge market of 5,000 in the index. You can probably put up some good active returns over the long term because of that.
Yeah, that makes a lot of sense. So Travis, I want to say thank you very much for coming in today and speaking to us on the Active Investor with SGH podcast.
Well, thank you. And thank you, Melbourne, for the great coffee.
You do love the Melbourne coffee.
I do.
You can say that one time in Sydney that you got great coffee.
It's become quite a problem, though. It's a stopping problem, as they say. So stop drinking the coffee.
Well, indeed, if you stop drinking the coffee, then I guess we'll have to edit this part out. Keep drinking the coffee has always been my motto. But thank you very much. It's been a great discussion. I hope our listeners have found this to be highly informative, and please reach out to us if you have any questions or follow-up for Travis.
Yeah, thank you.
Thank you. The Active Investor podcast is produced by SG Hiscock & Company. It does not constitute financial advice or a recommendation and assumes a certain level of knowledge. The views in this podcast are of the contributors at the time of recording. Returns are not guaranteed. Equity Trustees is a responsible entity for the fund mentioned in the podcast. This podcast has been prepared by SG Hiscock & Company to provide general information only. It does not take into account the investment objectives, financial situation, or particular needs of any particular person. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as an indicator of future performance. You should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product.